Hi and welcome and thanks for joining us for Harris Viewpoint today. I'm Debbie Senior and this is my colleague Lynn Tweedale. Over the next 30 minutes or so, we're going to take you through some self-funded research we've done amongst 3,000 adults in the population about what they think of their retail banking relationships. Whilst we go through the seminar, you'll be able to post questions and we'll endeavour to answer as many of those as we possibly can towards the end of the session.
There's a claim that we're with our banks longer than we are with our romantic partners, with the average current account relationship lasting 17 years, but the British marriage ending in divorce after 11. Now, we do know that banking is lagging behind other industries when it comes to relationships and being customer focused. And indeed, George Osborne earlier this year in his speech did try to nudge banks to become more competitive and to focus on their customers' needs. Now, we know it's not going to change overnight, but the current account switch service that recently came into place is making things easier to switch. And it's now claimed that 89,000 people have successfully switched their accounts since the service came into effect. But, like all relationships, being in one doesn't necessarily mean that we're happy. Of course, all of this is amongst the backdrop of various different headlines of poor service and reputational issues, and customers being more and more demanding. In fact, the Financial Ombudsman has recently launched some figures on complaints about current accounts alone, and they say that complaints on current accounts have increased 34% on last year. The landscape is also changing. There's new entrants to the market, taking benefit from the legislation around banking licences. Metro Bank are now in their third year of trading. Post Office has currently launched its current account in East Anglia, and they are looking to roll that out next year to other areas. But we also have other banks such as Virgin Money and Tesco Bank, which are hoping to launch their current account next year. And all of these have strong brands that are well known to customers. On top of all of that, banks need to be able to keep in touch with how customers and when customers want to keep in contact with them and resource those increasing demands.
So all a very challenging landscape. Where we're going to start today is really where we define a customer relationship. At Harris, we have a relationship score, and how we define that is taking the rational, emotional, intention dimensions of that relationship together as a holistic way of measuring that. What you're going to see here is this is a sort of heart and mind really of the relationship, and then we combine that with really the future behaviours that we hope to see from customers. On this particular slide, there are things that will be familiar to you. You know, you'll be measuring lots of sort of different tracking studies around overall satisfaction with that relationship, with the likelihood to recommend products and services to others, and we see very lot of prevalence in terms of their Net Promoter Score that's used within the sector. You'll also be very aware of the importance of trust, particularly given the recent landscape, not just in banking, but also elsewhere in the wider economy. One of the other things we do look at in terms of an emotional connection is how valued those customers feel. And from many studies that we do, we know this is something that can diminish over time. It's one of those things that maybe apathy sets in from the customer level, there's less engagement, but also from a provider perspective, it becomes more of a complacent relationship, and you've sort of forgotten to show, that you value that loyalty that customer's giving. We then bring the rational and emotional together, I said, with the intentional measures. And here it's all about, are customers going to be using your products and services going forward in the future? If they only had one choice, are you that preferred banking provider choice for those products and services? And then the really hard measure at the end is all about giving something different or offering something unique to that customer. And here we tend to see our lower rating scores. But ultimately, the differentiation angle and offering that uniqueness is a real sort of business success sign of a really sort of strong business performer. And it's also really important in your particular sector, given the sort of prevalence of both the regulatory side, but also the sort of commoditization of products, which means you need to think about how you can stand out from the crowd in other ways, like service delivery. So one thing that we do in terms of the sort of customer ratings that we gather on each of those dimensions is start to put people into segments of how connected they actually are with you. And you can see 6 different options on the screen now. The fully connected are those people who are rating at least 4 or more on all of those different aspects of the relationship right now. And this is really ideally the ultimate of where we want to be. But what you can also see is there will be people who are falling into maybe the neutral category, those who are indifferent towards the relationship. And those people, more worryingly, they're actually disconnected from you. And these are people who are potentially at risk. So, why is this important and why do you want people to be connected? Well, when we look at sort of banking and we look at the sort of retail banking industry as a whole, we can see actually you've got a pretty good relationship score on fully connected. Nearly a third of those customers we interviewed are saying that they're in that category. The issue we've got though is this doesn't apply to all banks. And Lynn will be going through in a couple of slides about sort of, how the banks do differ on this particular measure. The opposite side that we see here though is the polarisation of these levels of connectedness. And just under half of all retail banking customers are falling into either the indifferent or neutral category, and also those who are actually disconnected or at risk. And the relationship scores you can see here, we've got a scale out of 5, with 1 being poor and 5 being excellent. And the issue we can see here with the indifferent customers is 3 out of 5 is purely good. And that's not going to be good enough to actually retain some of those customers going forward. They're going to want more. And when we look at the disconnected group, although it is a smaller group at this particular stage, but they're actually rating fair or poor. And that is not going to be enough to actually retain their business.
From our research, we know that more than 1 in 10 are going to choose a bank based on recommendation if they're looking to switch, which is second highest only to already an established relationship with a brand through other products that they may have. So it's clear that recommendation is important. And therefore it's clear to make sure that customers are fully connected and acting as ambassadors for your banks. But it's not enough just to be emotionally engaged. They need to be rationally connected too. Now you can see from this slide that those that are connected in some way do have positive NPS scores. So they will be giving positive word of mouth and are less likely to switch. Those that are indifferent, it's probably more apathetic given that their switching potential isn't actually that high. But there is also the risk there of them spreading some negative word of mouth. But looking at those disconnected customers, they aren't going to stay. There's a very high probability that they're going to switch and at the same time be spreading negative word of mouth about your brand.
And the other side that we need to sort of bear in mind of this is not just where we're at now, but what ability banks actually have to cross-sell other products and services to those customers. And within the survey, we asked the customers how many products they already own and hold with that provider. And on average, we're getting 1 or 2. And that's despite which actual segment they fall into. But the real issue that we're sort of trying to drive here is the commercial sort of reality, I suppose, as to what you could and the potential that you've got where you've got fully connected customers on board. And you can see very clearly in this graphic that we're showing is how open the fully connected customers actually are to a whole range of products from insurance to mortgages to savings and investments and so on. And they're even more on board than just the rational emotional connections. You're able to sort of cross-sell potentially longer term products to those people who are really fully connected with you. And that's extremely important. And it also shows, given that they've only got 1 or 2 products at the moment, what potential there actually is if you can define who these customers actually are. On the opposing side though, when we start looking at sort of those people who are indifferent or disconnected, you can really see there is just no potential at all for those people who are disconnected in that relationship. They are absolutely going to be looking elsewhere for those products and services, and it's not going to be something you can retain. The indifferent customers as well, there's very limited sort of commercial value on those people because they're really not going to be looking at more than they currently hold with you. So the issue for banks is those two particular groups of customers are really purely a cost to your business, and the commercial potential that you can get from them just doesn't exist.
So this does emphasise the need to link together all of the knowledge that you have about a customer across all of the different systems that you have and every interaction that you have with them, and then segment and flag these customers within your CRM systems. A customer may, for example, log in to search for information on a mobile or tablet before perhaps phoning telephone banking to ask some queries and get some answers, before finally applying online. So across all of these touch points, it needs to be consistent for ease so that customers can quickly access various different bits of information, and it makes it easy for them to want to stay and complete the application with you. So it would be ideal to try and retain information to avoid customers having to repeat steps across the various different channels. So opportunities here can be better targeted for interactions to be seamless across all channels and to inform them of products that may be of interest to them in a timely manner through a suitable channel. Now, something that I have seen working particularly well here is Barclays with their online apps. And in fact, they've been offering various different products and services in a timely manner through their app situation. Now, as Debbie mentioned, that was the industry picture, but not all banks are the same. First Direct, Nationwide and the Cooperative all have the highest connected and therefore strongest advocacy levels. But this isn't really a surprise. But what this does say is that these are going to be better placed to benefit from switching as and when it does come into place. What is concerning is the lack of differentiation among the rest of the mainstream banks and the sheer size of customers in those banks that are indifferent or disconnected. So we are starting to see more new products and differentiation coming into the market, especially since the switch service has come into place, but this hasn't filtered through to customers' perceptions of the brands. And indeed, many of the new product innovations that would have differentiated a brand a while ago are now being replicated across brands. So whilst one bank may initiate a certain reward scheme, for example, and try to differentiate themselves that way, other banks are now copying, and the same thing is happening.
And within the survey, we also asked customers to rate the sort of performance of their provider on a whole range of different customer experience sort of elements. These range from, the value for money, the product side, the ability of staff to be knowledgeable and the staff manner that comes across in that relationship, and also the communication, the general service they provide. And what we can see in this particular slide, this is just a selection of those things, is how well sort of First Direct actually does perform on these elements, and sort of maybe what the difference is between them and the mainstream banks. Now, we all know that First Direct has a bit of a different positioning. It's maybe more niche. It's a newer sort of entrant to the market versus some banks. And also it doesn't have the sort of full selection of channels or complexity potentially in terms of dealing with customers. But what we can see here is the percentage figures of the gap between the First Direct customer performance ratings and those ratings that we get from customers who are currently with those mainstream banks. And what's most concerning is even though you may not be able to reach the levels of First Direct or even want to reach those levels due to sort of resource and other issues, but you need to sort of the amount of effort that you're going to need to put in to reach those customer needs is quite considerable. And this is going to take sort of investment across technology. It's going to be retraining of staff in terms of the manner and how they come across and also their product knowledge. And also just in terms of sort of general resource. And that's quite a sort of, it's not an insurmountable amount, but it's going to take a considerable amount of effort. When we look at the bottom three sort of banks in the mainstream banks, they're typically the likes of Royal Bank of Scotland, HBOS, HSBC, Santander and NatWest. So we've sort of looked at within the industry, but it's also quite useful to look at external comparisons. And again, within the survey that we run, we also asked, are you a customer of other financial services products? And we looked at here sort of car and home insurance and credit cards. And also, how the sort of customers compare, with mobile phone operators, satellite TV providers, and also the infamous energy market, which is going through a considerable amount of problems at the moment. Now, what's interesting here is that the amount of fully connected customers within retail banking is actually slightly higher than we see for some of the other sectors. But the concern that we see here is really because of the relevance and the importance and really the sort of day-to-day level of activity that those customers have with their retail banks. We would really want to see that fully connected level be far higher than it is, particularly in comparison to other sectors where there's much less activity and engagement involved. And also the level of indifferent and disconnected customers that we also see in comparison to some of those other sectors. Another sort of element within the survey that we looked at was all around the sort of changing use of channel and preferences. We know that things are moving forward, and although traditional sort of methods of communication are sort of still important to customers, the online and the sort of mobile side is coming through more and more, and it's only going to go in sort of that particular way going forward. So what we've done here is we've looked at a whole wealth of data from, what channels they use, how frequently they use those channels, and what type of transactions activities customers are using via those channels. And we've created sort of 5 different groups here on a segmentation. On the left-hand side are those people who purely use online for most of their sort of relationship transactions. The next group are people who are using mobile app a lot more than anybody else, and it's an important channel for them, but they are still using online and other traditional channels as well, so they're much more multi-channel. On the right-hand side of the slide, these are the customers that actually want to use more of the traditional channels more, and they typically use the online for more transactional behaviours, and when they want something more complex, they default back to sort of telephone and branch. Now, there's a couple of things on here which are really striking. Not only sort of the more likely customers are to be fully connected, that's actually driven by the traditional bank engagement that they've got. And that's going to be partly driven by the fact that they've got staff contact and a level of personalisation that they see coming through from those traditional banking activities. But also on the converse side of that is really the online-only people on the left-hand side. And the worrying aspect there is how few of them actually feel emotionally connected with their banking provider when they're actually going through sort of everyday activities in that relationship. We also see much higher levels of people being indifferent and also disconnected when they're only using that sort of channel as a connected layer. And when we look at the sort of metrics that we talked about earlier, the feeling valued and the amount of trust that's built up in that relationship, the online-only channel rate both of those far lower than any other customer does.
So as Debbie mentioned, there are customers there that are using the apps relatively more than any other group. But as you can see from this slide, they are also using a wide range of various different channels and are using these more frequently than anyone else. In fact, when you look at the number of different transactions that they will make on average per week, there's 7.7 different transactions each week. So whilst, yes, some of that will be via an app or online, which is self-serve, they are still drawing on the resources of a bank and telephone branch, which is obviously still going to be pulling on the resources of the staff. And this is showing a bit of change in behaviour, but on these particular people, as we've seen, they are still using the branch, they are still using the phone, and are therefore getting some emotional level of interaction through the staff and human interaction that they do have there. What you can also see from this slide is that from an online point of view, it's still a very largely used channel across all different customer types. So if online isn't working, as we perhaps have seen on the previous slide, it's being used by everybody. Now, Online and mobile were initially seen as mutually beneficial. Customers could access and transact at a time and place to suit themselves, and conversely, would require less resource from a bank position. But what seems to be the case is this technology has actually distanced the brand and pushed the relationship further away. So how can banks build a relationship remotely? Well, it's seeing everything in a holistic way, joining up all of the information that you have on a customer, no matter which channel it comes from, and then offering friendly and timely messages to customers and treating them as individuals, tailoring messages to them. Perhaps, for example, personalising their login pages when they do go online, offering them the services up front that they do use frequently. Maybe even trying to personalise it a little bit more. We know that photos on credit cards of your family, for example, have been a great success. So perhaps when setting up targets for savings, enabling them to put a photo of the car that perhaps they're saving for as a drive towards an emotional attachment and feeling satisfied at the end of it. Now, money management is something that is now fairly common, especially for tracking expenditure that has gone out for shopping and travel, etc. But Think Money are actually being more proactive about this. They are helping people to manage their money in advance to make sure that bills are covered and are building a relationship with their customers that way. So help people then manage their money. Congratulate them when they've received a savings target, but don't go too far. There is a fine line of a bank being helpful and recommending products that may be suitable to them, or perhaps, for example, reminding someone if their credit card bill needs paying, because it will be saving them money and seen as helpful. What we do know from our research is that being too intrusive, for example, telling somebody that they've gone overdrawn, but you know they've got lots of money in their savings account, is seen as too big brother, and they don't like it.
Okay, the other side of sort of relationships is maybe more negative, but as Lynn sort of pointed out in the introduction, was about the number of complaints that the retail banking industry has seen, and also the amount of coverage in the press about this sort of particular element. And within the survey, we know that just under a third of sort of customers across the whole range of the sector have actually made some complaint at some stage in their relationship with banks. Now, when we scale that up as to the amount of people who actually have a bank account across the population, that's about over 13 million people. Now, complaining is just one of those things of life. At some stage, we will always have a complaint to make. And if actually dealt with properly, it can make quite a big difference and a positive enhancement to that relationship. It's not always a negative thing. But the concern here is we also ask customers how well they felt their complaint had been fully resolved. And under half of the people within our survey actually said that their complaint was fully resolved to their ultimate satisfaction. That's an awful lot of unhappy people in the population. And again, when we scale that up, it's about 5 or 6 million unhappy people. Now, there are two sides to this. There's a cost side. And when we've looked at sort of figures that we've seen from Ofwat, and we translate those across potentially to your own sector, there's about £5 or £20, cost per complaint that's made, depending on the channel that's made through. And actually online can cost more than other channels. And that scaled up even on a basic level amounts to about £100 million across the sector in terms of what these things are costing you. Never mind the fact that when they're unresolved, you're getting negative word of mouth from that. And the other really clear thing that we see from the figures that we've got on the slide here is how linked the inability to resolve a customer complaint is linked to the fact that the person is then indifferent or disconnected in that relationship, and then the circle sort of gets fulfilled from there. So we also look at sort of why customers are actually switching, what's turning them off from a provider, why are they actually going anywhere else? And about half of the customers have said they've switched at some point in their lifetime. There's about 1 in 10 have said they've done so in the last 12 months. Now, there's sort of push and pull factors at play here. Some of the things are about the grass is greener elsewhere. You know, they see a better offer, or maybe there's some product innovation, or they see that the product's more relevant from another provider, and that attracts them to that provider. But there are other elements around, you know, the delivery of customer service not being up to scratch to meet the customer needs. As we saw before with the complaints, it's about really resolving those issues and giving the support to the customer when they most need it. And then the emotional side that we saw earlier, again, one key factor is they just don't feel valued anymore within that relationship. And it's a combination of these factors that tend to sort of make people move.
We know from our research that 10% say they are likely to switch in the future. And what we've done is we've studied the difference in ratings of these customers' perceptions of their current bank against the perceptions of the brand that they say they are going to switch to. And that's what you can see on this slide here. And this is the areas that show the largest uplift of the service they feel they're getting against the service that they know they'll be getting somewhere else. And what seems to be scoring highest here is rewarding you for your loyalty, offering new and innovative products, the relevancy of the products to me, and value for money. Which, as Debbie was saying on the previous slide, are all reasons why people say they have switched. So it complements again to show that this is now what they're looking for after an experience. This is what they want from a new provider. When we asked people who they were going to be switching to and who ultimately are going to be the winners in the switching competition, it's Nationwide, NatWest, Santander and Lloyds TSB, as it was, that were the highest in consideration sets. Those that were disconnected, and therefore those that are more likely to actually switch, it was Nationwide, Santander and First Direct, which was much higher, which may indicate that these customers are looking for a brand with something different with which to engage. What is really interesting here is that there's a number of brands that don't yet offer current accounts that are in people's consideration sets. Retailers such as Tesco's and Sainsbury's, Marks and Spencer's, John Lewis are all considered by 1 in 10 people, which just goes to show that a strong brand can easily be diversified into. And these are going to be threats to traditional banks when switching does become easier, and with more and more banks being able to open due to legislation changes. What is also interesting in this slide here is how Santander polarises opinion. It's top of the consideration set for some people, but also top of the rejection set for others. Now, we know they have made headway in appealing to customers with innovative products, but it does appear that past perceptions of performance is taking some time to fade. Now, in our research that we've been running for many years now, we have been monitoring Santander, and we've seen improvements in all areas of the relationship, rationally, emotionally and intentionally. So it'll be extremely interesting to see how this progresses. Now, there is a long-standing debate of whether the low levels of switching is due to perceived complexity or perceived risk if something goes wrong, or whether or not it's just apathy of people not paying attention to a service that they don't pay for with free banking. Now, there is one step to finding out, and that's the current account switch service, which recently came into effect. And as I mentioned at the beginning, it's claimed that 89,000 people have successfully switched their current account so far through the service. And indeed, Money Supermarket has also said it's seen a 45% increase in people using their services to compare current accounts. Now, we did research awareness of the current account switch service back in August, and a third of people were aware of the service and the benefits then. Again, we repeated that in October, and now 2/3 of people are aware of the switch service, which goes to show that the advertising campaigns have been recalled well. But is this going to change long-term behaviour? Well, the switch service says that they've seen an 11% increase in switches now compared to the same time last year. I mean, it is early days, but it is encouraging. Now, our research does seem to indicate that knowledge of the switch service and its reassurances has unsettled the market. As you can see from this slide here, this was amongst people that were currently unaware of the service and their likelihood to switch on the left-hand side. But after informing these customers of the switch services and the reassurances and benefits of it, on the right-hand side is their likelihood to switch now knowing that service is in place. What we do see is that there's very little change as far as likelihood to switch, but there is a significant decrease in people now not going to switch at all under any circumstances, and a large increase in people that are now unsure of what they would do, which goes to show that if the situation arises where they perhaps do want to switch, it's more likely now that they will do using the switch service.
So sort of to end our seminar, we're going to look sort of at what positively the sort of elements are that banks can do to address these relationships and to sort of retain existing customers at a more fully connected level, as well as, attract new customers because, switching potentially is more open. And what has become apparent from the work that we've done is there are a few similarities in those priorities, but also you've got to offer different things to those different customer types. So your retention acquisition sort of strategy has got to have those differences included. And what we can see here is the existing customer priorities and just the demands and sophistication of those customers and what they're expecting you to actually deliver to make them happy. It's a whole host of things, from the general service you provide, the communication that you deliver and the clarity of that. And it's not just about the products and services and the value for money, but as we saw earlier again, this thing around dealing with my issues and supporting me when I most need it, and also emotionally treating me like I'm an individual customer, which is that, valuing me, that emotional sort of engagement level. You've got to get all of these things right to really drive that sort of satisfaction and loyalty level. But on the opposite side, when we look at actually what you need to show to bring customers to you from other providers, again, there are some similarities around the service level, the communication sort of side of things. But here, not surprisingly, we see, the innovation come through. You've got to have sort of competitive charges and fees in terms of their perceptions of those, at least. And that's not surprising that we see a lot of banks, putting those types of offers out to the market to sort of, make that attraction look better to customers. But the other thing that probably is underestimated by banks is the role that staff have to play in this. And it's about how they come across, the manner, the professionalism. But also don't forget, because people are switching due to sort of, some element of negativity, it's not always to find something different in their product. It's because they don't feel they've had that support from their existing bank. The amount of understanding and empathy that staff shows is highly critical at this moment in time to get that new business. And that means that, focusing on training of the softer skills of staff are going to be increasingly important. The other side of this is when we talk about that holy grail, I suppose, of driving differentiation in the marketplace and really having that stickability with customers, or that real difference to attract others because they can't get those things anywhere else. Again, some of those things we've spoken about before, but the one really key thing that stands alone in the whole of this is that customers actually want to be rewarded for their loyalty. And this isn't about financial reward just per se. Obviously, that's going to play a part in it. But what we do know, it's about it's wider than that. It's the wider emotional engagement and also the wider holistic experience that they get. And just to sort of share a couple of examples, just one from my own personal point of view. I'm in a situation where I'm moving house. I've been with my mortgage provider for the last 10 years. I've been very loyal to that mortgage provider and they've earned money from me. But when it came to actually wanting to enhance that particular product, I've had lots of conversations with them. All the effort has been on my side. And ultimately, when I got to the point where I actually turned around to that provider and said, really, it's getting to the point where I don't feel valued anymore as a customer, and I really don't think you want to retain my business anymore. And I was told, no, we certainly do. I never got follow-up from that. They never took it further. They never showed any proactivity. And that instantly has led me to just move to another banking provider for that particular service. So there's no engagement and no recognition that over that period of time I was a worthwhile customer to keep. And I think that's the sort of level that banks need to address. The other two interesting things that we've seen recently outside of the sector and how they are sort of trying to reward loyalty. And again, it's not down to just the price and the value for money and the cost side, but one of them is Tesco. Now we saw it sort of polarises people on the sort of banking side, but in my sort of opinion, I think Tesco is very switched on to marketing and how it communicates its brand positioning. And in the sort of recent months, it's changed its sort of tack, I suppose, and the way it approaches the market by saying it's not about the loyalty of the customer to Tesco, but actually it's about the loyalty that they have to the customer. That might sound like a slight difference, but actually it speaks volumes to retain that sort of customer relationship and keep it going. And what they're doing there is not showing just that people can get discounts for shopping, but they're trying to enhance the experience and make that better for those people who do show loyalty and shop there more often. The other organisation I think is worth sort of picking up, very recently, I think it's happening this week, is John Lewis. Now again, we know that John Lewis polarises different groups of people for different reasons, but it's actually very well known for its customer service and does sort of often get accolades for it. And what it's done again this week is decided to introduce the sort of my John Lewis scheme. And its initiative, again, not to drive discounts or cost because they don't want to compete on that price level, but it's all around how they can better engage with sort of existing customers and give them something back for the level of loyalty that they show. And it's about putting people into prize draws and giving them relevant sort of products and services in return for that. But whilst they're shopping, it's also about giving them sort of tea and cake whilst they're doing so, making their lives a little bit easier and nice while they're doing so and spending their money there. And I think those are two very interesting initiatives that maybe banks can take on board and do something to address, because again, it's not just the rational side, but that emotional element of loyalty that really needs to be looked at. Okay, we've sort of come to the end of the seminar for today, and thank you very much for joining us. We hope you found it interesting and informative. We have a wealth of data that we've collected, and we're very happy to share that with each of you if you want to get in touch and ask more questions. I believe we do have a couple of questions, and we have maybe 5 minutes left of the seminar. So maybe if we can address a couple of those for you. Any that we can't pick up at this moment in time, we will endeavour to come back to you personally.
Well, there's one here from Angela Swanell. Thanks for joining us, Angela. She says, you mentioned that apathy to switching may be linked to free banking. From your experience, do you think it'd be beneficial for banks to start charging for accounts or for more packaged accounts? Well, certainly in our lifetime, paying for a bank account isn't something that we've really had to deal with. But I certainly do think that not paying for a service will lead to an apathy about it, and certainly unless you're exceedingly unhappy, are you going to think to put the effort in to change? Package accounts, I suppose, have become a bit more prevalent in recent years, but again, so has the negative press about it. Indeed, mis-selling has come about from packaged accounts for offering insurances that perhaps you couldn't actually claim from at the end of the day. And if you are paying for that service, that's not a good thing to do. Now, I do know from our research, actually, that we've looked at those that do have packaged accounts, and I suppose we can use that as a proxy for paid for accounts versus people that have an ordinary account. And we do know that those with packaged accounts or paid for accounts actually do have a stronger relationship with their bank, certainly from the emotional and rational side, but also very much more from the intentional side, being that they are getting products back for it. Of course, we're on now, from my perspective, new entrants to the market. Santander, for example, they have dropped their packaged account side of things, but the 123 current account is in effect a paid for account. And what I feel is beneficial from that perspective is that customers are going about their daily business and are seeing the benefits of the rewards from doing their ordinary everyday transactions. They're earning points and recognition for the relationship with the bank. From another perspective, personally, I'm a NatWest customer, have been for many, many years. They've copied a similar kind of trait there, though not actually paid for, but trying to replicate the rewarding me for using my debit card. But I'm receiving statements every week to tell me I have no points purely because of the limited number of retailers that they actually have their agreements with. So again, I'm not receiving my loyalty for my services. I don't know, Debbie, if you know of any other markets perhaps where paid for services come to
I mean, I suppose I would say with free banking that the problem is when you give anything for free is that people don't understand the value that's attached to that, or also the cost of delivering the experience for that is taken sort of really as granted, and that lack of understanding is prevalent. So at least if it's a paid for service, then that value will be recognised. But the issue that the sector will have, and I think it's what other sectors are seeing, particularly you see it in the energy right now with the discussions that are going on this week, is that as soon as you start sort of upping the price or charging for certain things, the expectation and the demand level from that customer also increases accordingly. And you're really going to have to up the experience to be able to sort of meet those even further needs that they're going to put in place. So I think that, there's a definite sort of challenge there. But also, I suppose I'd say was it's not about just putting a product out there. It's really demonstrating the benefit that that's going to bring for the amount that person's spending. And the sector that I do like quite a lot, I suppose, is the airline sector, the travel sector. And when I think about, I'm part of a loyalty scheme with British Airways. And, I have to pay for my flights. Sometimes I do get, slight discounts and things like that from point systems that I get. But generally, it's a paid for service. But what I do get in return for the loyalty that I have are benefits. So I get, things like fast check. I get to sort of, go into lounges and things like that and have a much more relaxed view of life at the airport. And that, if that's packaged in the right way from banks, I think could be quite a benefit.
Well, there's a question here from Rosie Hayes as well, which I think you have touched on there as well. Do people who pay for their accounts have even higher expectations? And I think, Debbie, you did already cover that.
Yeah, I think you're absolutely right there. And I think it's very difficult to sort of manage for that. But I think if you think of anything that you pay for, your expectations are going to go higher. But I think it's the clarity of the communication and what you're going to get back for that. And you've got to personalise that for customers. That's going to be incredibly important.
Well, I'm aware that we're rapidly running out of time, so...
Okay. So the last thing we just wanted to end on, and again, thank you very much for your time today. And if you do have any other questions, feel free to sort of get in contact. If you have enjoyed the sort of first seminar in this Harris Viewpoint series, we do have another one coming up on a very hot topic that many of you might have an interest level in, which is social media usage in the UK. And what we've done here is just demonstrate on a very basic level the different sort of size of segments across the retail banking industry between those light users and the very heavy social media users. But also what's quite interesting in just the analysis we've had a chance to have a look at is the more sort of social media use you get, the more connected that customer actually is. And we get much higher ratings on advocacy, how sort of valued that customer feels, their sort of ratings of trust that they have in the relationship, the differentiation that bank has, but also being open to then owning more products and spreading the word about you. So hopefully you can join us for that. And again, thank you very much.